Okay, let's work through an example of control through purchase of net assets using cash. So in this example, Cake Company offers to buy all the assets and assume all the liabilities of Cookie Company. The management of Cookie accepts the offer. So assume that on January 1st of year 2, Cake pays $95,000 in cash to Cookie Company for all the net assets of that company and that no direct costs are involved. And because cash is the means of payment, Cake is the acquirer. Okay, so the first thing we have to do is calculate the goodwill on this example. So we take the acquisition cost, which is the cash paid. So we'll type in 95,000, and the fair value of the net assets acquired of Cookie Company has been calculated below. So the fair value of the assets is $80,000 in total. So the fair value of the assets is 109,000. The fair value of the liabilities was 29,000. So you subtract that to get the fair value of the net assets. Make that in bold to 80,000. So that's what we plug in up here, 80,000. And then the goodwill is simply subtracting 95, the acquisition cost minus the fair value of the net assets to have $15,000 for goodwill. And then the next step is to make a journal entry for our acquirer, which is for Cake Company. So Cake Company, we're going to be debiting the assets. So the assets are going to be debited, which is going to go up because we're acquiring in the amount of $109,000. So I'll just use that right there. And then it also, our assets are going to go up, or we're going to debit goodwill, which is the $15,000 that we calculated. And then our liabilities are also going to be credited, and that's going to be in the amount of the fair value of the liabilities of Cookie Company. And then cash is going to be going down in the amount of what we paid, which is $95,000. And we'll see that this balances to $124,000 is debited and $124,000 in total is credited. So that's to record the acquisition of a Cookie Company. Okay, now we have to update the balance sheet. It's very important to take a look at the balance sheet for these. So the balance sheet here at the beginning, at December 31st, before we made the acquisition, before Cake made the acquisition of Cookie Company, so the assets were $300,000, the liabilities were $120,000, and the shareholders' equity, we had common shares of $100,000, retained earnings of $80,000 for a total of $300,000 for liabilities plus shareholders' equity. But now we need to update it because now Cake has acquired Cookie Company. So the assets are actually now going to be interesting. It's going to be actually, let's just go here, $300,000 plus the assets that we acquired. So it's going to be the fair value of the assets. And remember, we paid cash, so we have to subtract the cash that we paid. So we're going to subtract the $95,000. So our new assets are actually $314,000 after we account for the cash that we paid. And the liabilities now are going to be what we had previously, $120,000 plus the liabilities of the Cookie Company that we have acquired. So that's going to be $29,000 that we add to $120,000. So our new liabilities are $149,000. And then we do not touch the shareholders' equity because we did not pay with shares. So we'll just add all these three together. And so it balances out. Oh, sorry, and I actually made one error, and it's good I did, because remember here, one thing we have to add is we have to add in the goodwill, which I forgot up here. So now it balances to $329,000 for the assets equals liabilities plus shareholders' equity of $329,000. Okay, now let's take a look at the journal entry for Cookie Company, the acquiree. It's helpful to take a look at the other side of what their journal entries look like. So the liabilities for Cookie Company is going to be, take a look at the balance sheet. It's going to actually come down. It's going to be debited now, so it's going to go down. So we're going to debit the liabilities. The cash is also something that's going to be debited. So it'll be $95,000 because remember, Cake paid Cookie Company $95,000, so that's always debited. Cash goes up. The assets, remember, are going to go down based on what was there because now Cake owns all the net assets of Cookie Company, and then simply. So now this results in a gain on the sale of the net assets and liabilities. So it's simply a plug. So we'll add everything on the debited side subtracted by the credited side. and we have a $37,000 gain on the sale of assets and liabilities. So we looked at the acquiree balance sheet. So Cookie had assets of 88,000, liabilities of 30,000, and their common shares were 25,000, and the retained earnings were 33,000 to equal 88,000 for liabilities plus shareholders' equity. So now we want to take a look at to see what the acquiree or the Cookie company's balance sheet would be at January 1st, year 2, after the acquisition has occurred. So remember, the cash has gone, the $88,000 is now gone to Cake Company, but remember we did receive cash for that, so our cash is going to be $95,000. And so that is going to be our assets. Our liabilities are zero, essentially because our Cake Company also purchased our liabilities, so that will be zero. So now our common shares are untouched because this was a cash acquisition, but our retained earnings are going to be different. So we'll take the retained earnings of 33,000 that we had previously, plus the gain on the sale, which was 37,000, and hopefully that should balance out to the what we have in cash, and it does. So that's what the journal entry and balance sheet looks like from the acquiree side of the situation for when we do a net control through purchase of net assets via cash. Okay, now let's do another example for control through purchase of net assets using shares. So similar idea, similar example, but now we're going to be purchasing Cookie Company with shares. So Cake Company offers to buy all the assets and assume all the liabilities of Cookie Company, and the management of Cookie accepts the offer. And on January 1st, year 2, Cake issues 4,000 common shares with a market value of $23.75 per share to Cookie as payment for the company's net assets. Remember, this is in place of cash. And then Cookie, the acquiree, will be wound up after the sale of its net assets. So the first step here is to determine who is the acquirer. It's very important. So shares of Cake Company, so we have Cake shareholders and they hold 5,000 shares, but then Cookie shareholders, after the acquisition, they will have 4,000 shares, and in total the shares outstanding will be 9,000 shares. But still, if we do the math of 5,000 out of 9,000 shares total, Cake shareholders still hold a majority of 56% of the Cake Company shares, and therefore Cake is the acquirer. And then the second step now is to calculate goodwill. So remember, we didn't really have to do the first step in the example of with the cash purchase. But then the calculation of the goodwill is exactly the same. So the acquisition less the fair value of the net assets acquired equals the goodwill. So the calculation, so 4,000 shares at $23.75 is $95,000. The fair value of the net assets is still 80,000. It's similar math. So fair value of the assets and of the liabilities of Cookie Company, and we have net assets of $80,000. So we plug that in here to get a goodwill of $15,000. So this is still the same calculation as it was for the example 1 where we did a cash purchase. Now we look at the journal entry here for Cake Company, the journal entry. So now our assets are still going to be have gone up by $109,000 because that's what it is here. Our goodwill has gone up by $15,000. Our liabilities are going to be credited for $29,000, and our cash has gone down $95,000. So again, this is also the similar recording as we did for the cash purchase. However, now we're going to see something different when we come down to the balance sheet for Cake Company, or the acquirer. So on the left is the balance sheet, which is the same as we did in the previous example, $300,000 of assets, liabilities $120,000, and common shares and retained earnings $100,000, $80,000 respectively, and it balances out. But now the balance sheet is going to look a little bit different when it comes to a share purchase. So the assets this time are going to be what we had previously, plus the assets, the fair value of the assets of the Cookie Company. So that's $409,000. Remember, it was different because our cash went down last time, but this time we're not paying with cash. So we're going to be playing around with the shareholders' equity side of the balance sheet. So our assets are now $409,000. Our liabilities, this part at least can be, and I made the same mistake as last time, plus the Goodwill. So our assets are $424,000. Our liabilities are still going to be similar calculation as last time, the $120,000 we had already, and then the liabilities of Cookie Company that we acquired, so $149,000. The common shares are what is going to be changing. So we had previously $100,000, but now our common shares, and that's what we were paid as the acquiree. We were paid $95,000 in common shares of Cake Company, so that our common shares have now gone up. Our retained earnings is untouched, so now our assets balance with the liabilities and shareholders' equity of $424,000. So it's, as you could see, the balance sheet is higher when we do a purchase with shares as opposed to doing a purchase with cash. So this can be something that you look into when you're analyzing the merger and acquisition of a company. So now let's take a look at the journal entry again. Similar thing what we did for the cash purchase. What would the journal entries and balance sheet changes look like for the acquiree or Cookie Company? So for Cookie Company, we have the investment in shares of Cake. So that was it's still $95,000, but instead of debiting cash, we're going to be debiting the investment in shares of Cake as our asset. Our liabilities are still going to be $30,000 as per our are going to be debited because that has been now sold to Cake Company. Our assets are going to be credited, or they're going to go down in the amount of $88,000. And again, here we have a gain on the sale, so we'll just simply do the math, which is the $37,000. So this part is the same, except that now we're debiting investment in shares of Cake instead of cash. Our balance sheet, as previously, was assets of $88,000, liabilities of $30,000, common shares of $25,000, retained earnings of $33,000 before the acquisition. After the acquisition, remember, our assets have all been given away to Cake Company, but we received an investment in Cake, so now our assets are going to be the $95,000 of investment in shares of a company. Our liabilities haven't been given away, so we have zero liabilities, so that part is the same. And now our common shares, this will remain the same because we did not do any transaction with the common shares. And our retained earnings is where we take what we had previously, plus we have the gain on the sale of assets. So again, similar idea as what we did previously, so $95,000. So the journal entry and balance sheet for the acquiree is similar, again, to what was for cash, save for the description of the asset, which is the investment in Cake instead of cash.